Dear students, welcome to Shasha's virtual classroom. So, this is a book by Catherine Kukom. So, chapter, lesson number C1P5. So, C1P4, A and B, we have discussed Frankfurt's book. So, the same concepts are discussed even in this. This is Catherine Kukom, it's from Catherine Kukom. Okay, so define the term bookkeeping. So define the term bookkeeping. So definition you need to learn. Definitions you have to write as it is dictated. So so you can see bookkeeping is a process of detailed recording of all financial transactions of the business. So this is what is bookkeeping. The next question is what is accounting? Accounting is a bookkeeping records. Uses the bookkeeping records to prepare the financial statements such as the reports. So the next question is why should you prepare financial statements? So the progress can be measured by comparing the financial statements that were done here with previous years, so the single calculations. Ratios, that information provided shows so many things. So it's a simple question and a simple answer you might have. So it's a very small thing. So state what is included in the term financial statement. So financial statements include income statement and position statement, or we call it as a profit and loss account and a balance sheet. Okay. So then assets, liabilities, and capital. So see the question here. So what are assets? Assets are something which the business owes and which is owed to business. So that is what is assets. So what are liabilities? Liabilities is something which is owed by business. So which the business has to pay back. So suppose you have taken loan. So that is what is liability. So you have taken back loan, you have to pay back. So that is what is liability. So you have purchased goods on credit, you have to pay back the money. So that is what is liability. So what are assets? Assets is something you have like land, you may have land, you are using it for purpose of doing the business. Maybe you have machinery to manufacture. So that is what is asset. So we using it, keeping it in the business to use it for some period. So that is why it's called asset. Asset is something. It is a resource controlled by an enterprise from which future benefits are expected to flow. So it is something which is owed to you and which you own. Okay. So what is capital? Capital is nothing but the investment made by the owner into the business. So that is what is called capital. This we have already discussed in lesson number one in detail. Uh, so very small thing, you fill in the missing figures in the following table. Okay, so what is this? The difference between this and this. So you know the accounting equation, right? What is the accounting equation? The accounting equation is assets is equal to liabilities plus capital. So, right? So what is the accounting equation? Assets is equal to liabilities plus capital. So this is the accounting equation. You have to remember this. So it means what this minus this will be this, right? So 35,000 minus 12,400. What is 35,000 minus 12? 22,500. So capital will be 22,500. Very simple. It's very simple thing. So capital. What are the sets in this case? They are given both the sides. So 300, that is 700. So 19,000 plus 44. 19, 44. 63,700. So here it is 63,700. So in this case, what it is? So assets minus capital is liabilities. So 67,300 minus 55,000, 12,300. So very simple. So very easy. It's very easy. I think you have understood. So you might have done this on your own. So even then, just for your confidence, I'm doing it. So that it's very easy concept, simple concept. Okay. So then, give two examples of each of the following, excluding show item in 1.1, excluding those shown in 1 asset. So other than these means cash. Okay, so cash is not mentioned here. It's not asset means cash. Give two examples. So cash can be one example. What can be the other example? Furniture is not here, right? So furniture. So here, what are the other example of liability? Bank loan. So what can be the other example of other one more liability? So loan from friend. Okay, from whomever you are taking, you have to pay it back. No, so it's a liability. Explain the meaning of each of the following terms. Trade payables. What is trade payable? Trade payable is nothing but when you purchase goods on credit at the time you have to pay back. No? So that is what is trade payable. So what is trade receivable? When you sell on credit at the time you have to receive back the money from the customer. So this is the money payable to supplier. This is the money receivable from customer. So So let us check. There are some exam style questions. Maybe like these are MCQs which keep appearing in the MCQs. Which task is performed by a bookkeeper? So analyzing the trading results, no. Entering transactions in the ledger, yes. Preparing year-end financial statements, no. Providing information for decision making, no. So which task is performed? So entering transactions in the ledger. This is the only thing which he does. Okay? So he will not do any of the other things. He will not do any of the other things. A trader provided the following information: premises 180,000, inventory 23,420, trade payables 26,180, trade receivables 21,710, other fixtures 32,600, loan from bank 80,000, cash at bank 2,550, motor vehicles 15,900. Calculate the value of the assets. So what are the assets? So this is an asset, this is an asset, so this is an asset, this is an asset. So this is also asset, this is also asset. So these are all assets, okay? So simply add this. So what you get is the sum of the assets, okay? So this is asset, so this is asset, so this is asset, this is asset. So then calculate the value of the liabilities. Value of the liabilities. So what are the liabilities? This one, loan from bank, or the liabilities, okay? So these are the liabilities. So this is L liability and this is a liability. Trade payables is a liability, loan from bank is a liability. Use the accounting equation to calculate trader's capital. So add all the assets. You see what are the assets? Let us check what are the assets. 180,000 plus 23,420 plus 21,710 plus 32,600 plus 2,550 plus 15,900. 276 180. 276 180. Assets are 276 180. So what are liabilities? So pound, okay. So dollar, no? So $20. Always in dollars. Liabilities is how much? 26 180 plus 80,000. So 106,000 180. So 106,000 180. So what will be the capital? This minus this. So that is what is capital. So 276 180. So it will be 70. Yes, 70,000. 70,000. This 7 plus 7. So 2 minus 1 is 1. So 170,000. Okay, 170,000 is the capital. Which is a statement of financial position? The calculation of amount owed to owners of the business, a list of assets and liabilities of a business on a certain date. Yes, a list of everything owned and owed to a business, a summary of money paid to and received by business. Now, a list of assets and liabilities of business on a certain date. So this is what is financial position. So then a business had dollar 9420 on its bank account. The following transactions took place. Bought goods on credit. This will not hit the bank account. This will not hit the bank account. So sold goods on credit. This also will not hit the bank account. Repaid a loan by check. So money will go out. So 9,540 minus 5,000 will be 4,000. So 9,420 minus 5,000 is 4,420. This one. So answer is this one. Okay. So that's all. Complete the following to able to show the effect of the following transactions. The first has been completed. Uh, as as an example, bought a motor vehicle and paid by check. So what are the two items that are hit? Motor vehicle and bank. So motor vehicle increases and bank decreases just because when you buy a motor vehicle will come in and you have to pay money, right? So money when you pay money, money will go out. So effect on liabilities, no effect on liabilities. There is no effect on liabilities at all. So this is how you have to do. It's very simple thing. So I think you can try on your own. So I will give you just a minute so you can take a screenshot. You take a screenshot of this question. Try it and we'll just discuss it. Okay. So just try on your own. It's a very simple thing. So if you don't understand, then you can do. See, this is how you have to learn. Otherwise, it will you don't watch the problem as a movie. Like just you keep seeing the movie, you'll not understand anything. Afterwards, when you start doing it, you'll get lot of doubts. No, no, you should never do that. So always what you have to do is you have to start doing the problem. Actually, you have to start and sit and write down, put it on pen and paper. Please put it on pen and paper. So please write down wherever, but you have to write down, you have to do the problem. Actually do it. So okay, actually do it and then check the result whether you've done everything correctly or not. Okay. So bought goods on credit from a credit supplier. So what are the two items that are affected? One is inventory. What is happening to inventory? Inventory is coming in. Inventory or goods. Okay. So it is called inventory, or they are called also called as goods or merchandise or stock or whatever. So it is called by different names. So it is called inventory. So then what is happening? Credit supplier. So we are purchasing from credit supplier. So creditor. So or bills payable. So he is known as accounts payable. Okay, it is also known as account payable. So what is happening? Inventory is increasing. So inventory is increasing. So creditor is also increasing. So both are increasing. So there is no effect on. So sorry. So here liabilities is here, right? So creditors will write here. Creditors they also increase. Okay. Then received a check from credit customer. Received a check from credit customer. So what is happening here? You are receiving money and it is a customer. So both are assets. So both are assets. So you are receiving money. So you are receiving check. So bank account. So bank balance is increasing. So bank balance is increasing because money is coming in. And debtor is also an asset, right? So debtor is a customer, so he had to pay you money. So debtor is also customer, but he is decreasing. Why? Because he's given you money, so he's paid you money, so that's why it decreases. There is no effect on liabilities. Sold goods on credit. When you sell goods on credit, what happens? Stock. So stock, so that is inventory, goods, stock, whatever you name it, call it as. So why I'm telling, because inventory is often used in A levels and all. So goods are often used, it is interchangeably used, and stock is also used. Okay, so anything, it is one and the same thing. It is nothing but the merchandise. Okay, so it is merchandise. So what happens when you sell, the merchandise goes out, the goods go out. So the goods or inventory, we call it as. So we can use the word inventory. So inventory, what is happening to inventory when you sell? When you sell, inventory will go out, right? So inventory will decrease, no? So inventory will decrease. So what will happen? Sold goods on credit. So inventory will decrease. But have you received the money? No, you have not received the money. Then what you have to receive the money in future. So a person has to pay you back. So one person to whom you have sold, he has to pay you back. So he has to pay. So it increases the receivables. So debtor, or it's called account receivable. Okay. So this is called accounts payable. So this is called accounts receivable. Okay. So accounts receivable. So in A level and all, most of the time we'll be using accounts receivable. So then sold goods on credit, paid off loan in cash. So what is happening here? Cash is going out. Cash is an asset. Cash is going out. Cash is decreasing. So there is decrease in cash. So paid off loan in cash. So what is happening? Loan is also coming down. So loan is also decreasing because you have paid. Loan decrease. Okay. So that's all. So this is how you have to do. So very simple logical. If you want more problems, if you want me to explain more problems, so please let me know. Don't feel shy, even if it is a very silly doubt. Please let me know so that we will discuss. I will explain to you in detail so that you understand the concept. This is very simple concept, but very important concept, so that you don't commit errors in the, otherwise you will struggle in the future. Like when you do the, if you move ahead, you will have to struggle a lot. So please don't do that. Okay, try to understand. And if you have any doubts, even if it is a very silly mistake, don't think that you will look like an idiot. So please ask me. So I will explain to you. So again, in different ways. If any problem or anything like that, you have any specific problem, also please let me know. So we'll discuss it. Okay. So don't worry. The financial statement of Bhavani Traders is given below. So statement of financial position, they have given assets and they have given liabilities. So here see, the assets they have given this side and liabilities they have given this side. So whereas in previous problem, that is chapter 1P4, I wrote liabilities this side, assets this side. So that is another thing, like this is the actual way you have to write. This is assets, always you have to write this side, and liabilities you have to write this side. So please keep in mind. Okay. So ultimately the figures matter, and even this also matters a lot, because this is how we have to write. Assets will come this side and liabilities will come this side. On 1st November 2014, the following transactions took place. A check for 3,000 was paid on to a credit supplier. A credit customer paid $500 in cash. A loan for 8,000 which was paid into bank was received from Lender Limited. A check for 7,000 was paid for an additional machine. Prepare the statement of financial position of Bhavani Traders on 1st November 24. The above transactions have taken place. Prepare the statement of financial position of Bhavani Traders after the above transactions have taken place. So how do you do that? So basically you have to analyze what is happening. So on 1st November 24, the following two transactions took place. A check for 30,000, 3,000 was paid to a credit supplier. So you have paid a check. So minus 3,000 from this, minus 3,000 from this. Okay. Then a credit customer paid 500 in cash. Credit customer paid 500 in cash. Cash 500. So credit customer paid 500 in cash. So customer, where is customer? Trade receivable is customer. So this will come down. So this will increase. Then a loan for 8,000 which had been paid into bank was received from lenders limited. A loan for 8,000 which was paid into bank. So it is increasing 8,000. So lenders limited. So lenders limited. Okay. So write down because it is not for trade payables. It is a loan. Lenders limited. So how much it is? 8,000. So then was received from lenders. Check for 7,000 was paid for an additional machine. Check was paid for additional machine. So machine is coming in. How much? Worth 7,000. Machine is coming in, and cash money is going out from bank. So money is going out from bank. So that is 7,000. So what will be the effect of this? So this will become 5,000. So this will be 35,000. This will be same. This will become 5,000. This will be 8,000. So lenders limited one adding will come. So machinery, this will become 19 plus 7, 26,000. So this will be 6,000 itself. This will be 4,900. So this will become 2,500. So this will become 2,500. So this will become 10,100 plus 8,000 plus 1,000 minus 3,000, 7,000, 10,100 minus 3,000 plus 1,000. So it will be 8,100. So the cash at bank will become 8,100. So cash in hand will become 500. So then this total will change. This total will be 40,000. So this side also total will be 40,000. Okay. So this is how you have to do this. So this is a very simple problem, very easy. Okay then. So this chapter is done. So this is C1P5. Done. So we'll see in the next class. Let's catch up in the next class with the next lesson. Till then, keep practicing, keep learning. So if you have any doubts, please let me know. So we can always discuss. Even if it is a very silly doubt, please let me know. So just write a comment in the section. So I will be very happy to help you. So we are here to help you. So please learn and please do good in your life. So all the best. Okay. Bye.